Welcome to Trade with Conviction, where oil, freight, and the markets that move them get the straight read. I'm your host, Jungo. Seems like half of Europe is on summer vacations, so it's left with just me and Jay today. Hi Jay, how are you today?
I'm fine, June. I'm well. How are you doing?
Very good. I just came out from Bloomberg TV, so that was quite cool as well.
Nice.
We've got a lot of things to cover today. A deal that seemed to be in reach, but turned out to be another type of deal. Do not expect a lot. Busy reporting season from IEA and OPEC's August monthly reports, and a
Yep.
special on the Great Milk Run, where we discuss ADNOC's shuttle that has enabled UAE to be the only Gulf producer that is producing above pre-war levels. Let's start with the market headlines. Okay, let's cover Hormuz and the Bab-el-Mandeb status. From the 6th to the 12th of August, we had 2 confirmed vessel attacks and 1 ambiguous incident. One was on an ADNOC vessel on the Strait of Hormuz. Another one was a cargo ship at the Bab-el-Mandeb Strait, which resulted in a fatality. And the UK MTO reported a container ship in the Gulf of Oman targeted by military forces. At the same time, we had the US Energy Secretary Chris Wright claiming on Tuesday that the 7-day average for oil leaving the Strait of Hormuz is up to almost 9 million barrels per day. And when combined with the 5 to 7 million per day leaving the region via newly upgraded pipelines and export facilities, total oil flows are averaging 15 million barrels per day. This is in contrast with the pre-crisis level of 20 million barrels per day. From commodity context, Rory Johnston, hi. The 7-day average of oil exiting Hormuz peaked nearly 7 million barrels per day last week. Even if you factor in dark transits, it's very hard to close that gap to 9 million barrels per day. So we also know that the rerouting of barrels in the East-West Saudi petrol line and UAE Fujairah pipeline is closer to 4 million barrels per day than the claim of 5 to 7 million barrels per day.
June, by the way, another thing which we saw in the news is that Iran has also reorganized its military, and it looks like they're taking a bit more of an offensive stance. They've said that they are preparing to take actions into the operation's enemy territory. They've promoted some really hardline leaders into senior positions. So in general, it doesn't look like a diplomatic solution is being reached anytime soon. The indications don't look so good at the moment. It seems like more protracted, more drawn out crisis. Let's also turn our attention to Russia, because I think a few important things have also happened on the Russian side of things as well. One piece of news that came out recently was the approval by the US Senate. They've approved a sanctions package on Russia, and this would allow the US to set tariffs of up to 500% on Russian imports, including oil and gas. And it would also importantly penalize countries that continue to buy Russian oil and allow for tariffs on those countries up to 100%. So this could really hit China and India hard, as we know they are major importers of Russian oil, especially because they're compensating for reduced Middle East supply. So if this goes through, and it's still an if, and if China reduce their crude purchases and India reduce their crude purchases, then that could also add to an even more constrained global crude market as well. I think it's quite interesting that this news has come across now, especially because it signals quite a U-turn from the world we were in maybe in March, where prices were closer to $100 a barrel, and the US was giving sanctions waivers on Russian oil and even Iranian oil at the height of the crisis. So this is definitely something we need to watch out for more. The next step is for the vote to go into the House now, which is in recess. So that will probably come out in September or so. So definitely an issue to watch going forwards.
Yeah, I think we should definitely keep an eye out on that.
Yeah.
So let me go into IEA now. So there was the oil market report for August that was published yesterday. I found it actually quite bullish. The key points that was number one, the Gulf oil production is still 8.3 million barrels per day below pre-war levels, and global oil supply estimates have been lowered to fall by 4.3 million barrels per day in 2026. Forecast for global oil demand reduced by 0.55 million barrels per day versus the July's report, due to disrupted international supply chains and curtailed product availability. Global oil demand is expected to decline by an average of 1.6 million barrels per day in 2026. On oil balances, there is a deficit expected of 1.8 million barrels per day in Q3 2026, more than double the estimate of around 0.8 million barrels per day in July's report. On refineries, we are looking at about 5 million barrels per day lower year on year in July for global refinery throughput, even despite a monthly increase of 1.8 million barrels per day. Seaborne product trade has fallen by 3.8 million barrels per day year on year, with US only showing that exports growth of 700 kbd. Finally, diesel and jet exports from Russia, Middle East, and Asia are down 1.3 million barrels per day and 700 kbd year on year, respectively.
Thanks, June. We also had the OPEC monthly oil market report come out as well. I think it's worth spending a few moments just to talk through some of the headline figures there as well. One of the main facts from this latest report is OPEC has lowered its oil demand growth forecast. Previously, it was expected to be plus 780 kbd. Now it's toned down to 580 kbd. Still predicting oil demand growth this year, which is an interesting viewpoint if I was to put it that way. I think it's also interesting to note the difference between what the IEA is saying and OPEC is saying when it comes to oil demand for this year. So on one hand, you've got OPEC showing a plus 600 kbd growth, whereas on the IEA side, you've got a 1.6 million barrel a day decline. So 2.2 million barrels a day swing between the two agencies. Such a big gap and even such a different direction. We'll see who's right in the end, but we can save that for future deeper discussions on another podcast as we get closer to the end of the year. On the crude output side of things, OPEC plus crude output, including the UAE, averaged just shy of 38 million barrels a day in July. That's up by 1.4 million barrels a day from June. This also matches with what you saw in the IEA report, increases from Iraq, Saudi Arabia, Kuwait. But I think it's also important just to touch quickly on the fact that this is a more conservative view on crude output increases compared to the EIA. So the EIA was much more aggressive in their short-term energy outlook. They said that OPEC plus crude production was up by almost 3 million barrels a day. So in short, clearly there's a very big gap even among the main agencies on how much production has recovered and whether global oil demand is actually increasing or decreasing this year, which is incredible in itself. What there is agreement on amongst the agencies is the main theme, which is of refinery outages and refinery capacity and refined products. Outages are above historical levels. The OPEC report cites disruptions, particularly in Eastern Europe / Russia and China, elevated maintenance in Asia and particularly China. So global refinery utilization is reported at just over 78% in July. Another issue to watch going forwards in the report was winter demand, particularly in Europe and America. Colder weather coming in, that could be supportive for oil demand in Q4, according to OPEC. I think there's some sense of irony in me talking about colder weather right now, especially given many of our listeners in London or in Europe will be suffering from a heat wave without air conditioning as I have here. But definitely a factor to watch for as we get towards the end of the year.
Right. I'll move on to a different topic. I call this the Great Milk Run. We've heard a lot of reports that ADNOC has been quite famous in managing to use vessels to service short trips between the ports inside the Strait of Hormuz and to ships just outside the Persian Gulf. This has helped them to be the only OPEC member that has not experienced any shut-ins since June 2026. And in fact, it's now producing above pre-war levels, estimating range around 3.8 million barrels to 4.1 million barrels. Yes, let that sink in, because this is in contrast to Iraq, that is still having about 1.8 million barrels per day of shut-ins in July, compared to its production of 4.4 million barrels pre-war. Kuwait is still shut in about 1 million barrels per day, compared to 2.5 million barrels per day production pre-war. And Saudi, which is 2.2 million barrels per day shut in versus the 10.5 million barrels per day production pre-war. All these data sourced from EIA's STEO, the short-term energy report. So how did ADNOC achieve this? They use a shuttling tactic, or what I call a milk run, with vessels turning off their transponders to avoid detection.
Nice. And would you consider this kind of milk run approach, I love the name by the way, would you consider this risk-free, or is there some danger to this milk run activity ADNOC has been doing?
Well, 15 of their vessels has already been attacked since the conflict began, of which 3 vessels were attacked last week. But it's not clear which of these were performing that shuttle service. 2 weeks ago, it was reported that ADNOC Logistics and Services bought 5 VLCCs from Frontline to expand its tanker fleet. They had already chartered about 25 crude tankers from Sinoco before, and about 15 vessels deployed as shuttle tankers, with the rest to supply customers directly. Now, ADNOC is reportedly offering spot Iraqi oil to Asian buyers. Typically, Iraqi oil has been offered by Vitol and Total. Note that there's big discounts on Iraqi crude right now, about OSP minus $25 per barrel for Basra Medium to incentivize this activity, as SOMO is selling the cargoes on Fort Basra terminal basis. This may be providing a lifeline to increase Iraqi production further, provided ADNOC can continue the great milk run without more attacks by Iran. All right, then I think we're covered with the headlines. So let's go on to the physical oil markets. Today, we will give some love and attention to the heaviest barrel first, followed by crude, before we lighten up on the clean products. Let's start with fuel oil, Jay.
Sure, thanks, June. So let's talk about fuel oil. Main theme for the week in fuel oil has been strength in the Singapore physical market. That's continued just as we expected. We can read our fuel oil commodity owners commentary for that view, and yeah, that seems to have come through really well. When we look at what's happening with the arbitrage, zero point 0.5 Rotterdam to Singapore arb on a Suezmax, that's improved in terms of economics, but even though economics have improved, if the cargo is going around the Cape, it's still shut by the range of $20 to $25 a metric ton for the second and third decade of August. So at this kind of level, we don't really expect much opportunistic or incremental flow from the West to come in and resupply Singapore just yet. What's interesting with this scenario is now we are almost in a vicious cycle where what's happened is the Sing market is tight, the Sing structure is steep. And when it comes to long haul voyages, particularly those from Rotterdam to Singapore around the Cape, this structure is making it even more difficult for that arb to flow. There's already a tight supply in Singapore. Demand is where it was before, or maybe even stronger. So the spread strengthen. The spread strengthen mean long voyages pay more in structure. This discourages long voyages, and this makes the supply balance even worse. And that also adds to even more structure strength in the spreads as well. So while this is a feedback loop going in one direction, it can quickly go the other way around.
Do you have any trade ideas for fuel oil then?
Yeah, so one thing on the basis of what we see with our sulfur curve, which we do in-house analysis of, when we look at the Rotterdam High 5, on paper, that's narrower about $10 a ton than where blend economics are implied. In Singapore, the opposite is true, where the High 5 is slightly wider. So from that perspective, you could do a pair trade where you could go long Rotterdam High 5 and short Singapore High 5. On a related note, when we look at 1% values from blend perspective, they haven't moved too much either. So we're seeing 1% is roughly around $50 a discount to 0.5.
Good stuff there. All right, I move on to crude then. At the top of the town, EIA stats, we saw 17.4 million barrels of commercial crude stocks built. This is mainly from increased imports of 1.1 million barrels per day and reduced exports of 0.6 million barrels per day. The biggest import is on Venezuelan crudes, but we might not see this as a sustained trend because arrivals for these Venezuelan cargoes are in lumpy VLCC parcels and could be clustered in this current week's reporting. SPR has drawn by another 6.1 million barrels, but who really cares nowadays, I would say. All right, then on the PG side, ADNOC has issued its 8th crude tender since the onset of the US-Iran war. The tender closes today, 13th of August at time of recording, with validity till Friday. The cargoes are for October to November loading and October to November arrivals. The usual suspects, Das, Upper Zakum, Lulu are on offer, but surprise, Melbourne is excluded this time. On the WAF side, crude premiums look to be going up, but they don't look particularly sustainable. China, for example, bought 2 cargoes of GNO at dated minus $10 per barrel. Then 2 more cargoes moved to other Asian buyers at below dated minus 5 levels. End users in India and China are also apprehensive at buying when freight is so expensive, with tradable levels of Dahlia now drifting lower. Basically, we are not seeing China buying at this level, and therefore it's not cheap enough. So China really only buys when cargoes get dirt cheap. Finally, we are seeing a group of crudes that are, instead of going up, they are coming down in crude diffs. One is the Iraqi barrels, we talked about it earlier.
Yep.
And now we also have the Med crude coming off. Because tanker rates are also shooting through the roof in the Med. CPC, BTC, and Azeri Light FOBs have fallen by at least $2.50 per barrel week on week.
Nice. So going back to our bread and butter, i.e. trade ideas, do you have any view on Brent-Dubai EFS given what you've said?
Yeah, Brent-Dubai EFS, we try not to call it for a long time because it's going against the typical expectation where you expect Dubai crudes to strengthen and therefore narrow, but it has not. Actually, it's been quite wide. October Brent-Dubai EFS is like around $10 per barrel. The forward months are narrower. And I think I want to look a bit longer term for this trade idea. If things normalize in the market, there is normal flow in Strait of Hormuz. We know that UAE is out of OPEC and they are going to produce more crude, more production if they can. So there's going to be a lot more supply from the Middle East angle. But at the same time, on the Eastern buying pattern, we have looked at Japan and Korea, and they are definitely on the supply diversification angle. 5 to 10% of this crude state, to me, will be permanently displaced by the insurance grades from the US, from TMX crudes from Canada, which means that equivalent amount of AG crudes will get kicked out of Asia. And this crude needs to up somewhere. And it can go either to Northwest Europe, Med, or the US. Directionally, what this means is that Brent Dubai remains wide for this up to be open and more open than to the Atlantic Basin than pre-crisis. So I think we should be looking at the back of the curve for trading Brent Dubai.
Really interesting. Thanks, June. Let's move on to disti now, middle distillates specifically. And really, middle distillates are the big story, especially diesel on products. When we go back to what we saw in OPEC and IEA's monthly reports, both of them emphasize how strongly Atlantic Basin middle distillates cracks are and refining margins are either at record or multi-year highs. As we said before, this is really a product supply problem the market is facing right now, not a crude problem. And by product supply, I mean operating refinery capacity being one of the core issues that needs to be addressed. I think one thing is that we've seen refinery margins be really, really good for quite some time now. And maybe we're starting to see the impact of that through unplanned shutdowns. And really, this refinery outage list really keeps growing. Prefchem's RFC unit in Pengerang is down. MRPL has a CDU and a hydrotreater down. Jazan, they were meant to resume in the middle of this month. Now they've slipped their restart date to the end of August. And meanwhile, on top of this, we've also got Ukraine striking Russian refineries again. The EIA explicitly said the Middle East product export disruptions plus Russian refinery attacks account for 370 kbd cut to their Q3 global refinery runs. So clearly, refinery runs, refinery outages are a big issue. We see that happening and its impact on distillate cracks, distillate spreads.
So what are the distillate ARBs looking like at the moment?
Yeah, so really interesting with the ARB picture because maybe it's a little bit counterintuitive. Right now, if we look at Houston, Rotterdam, the diesel ARB is open at the prompt, but actually this is narrowed very, very sharply from almost $30 a ton earlier this week. Looking ahead, that ARB route from the US to Northwest Europe isn't holding at all. Next month, it flips to negative territory and stays there until January. If we look at what's happening from West Coast India into Rotterdam, that's also properly shut. The dashboard has a negative return for August loading. It gets worse for September, and even worse still if you incorporate going around the Cape, which is also an option that's being used. So Sikka to Rotterdam doesn't really turn positive until December or January either. But actually, if you want to know where the diesel does look like it's working right now from Sikka, it's actually into the Med. So when we look at our data, we can see the Sikka to Aliaga route is one of the only ones showing a positive margin today. And that makes sense when you think about it from a couple of perspectives. So one, Russian diesel export ban is in place. Turkey is the massive consumer of Russian diesel. So they need alternative supplies. India is a good supplier from that front. The other aspect of it is also what you discussed earlier, June, about CPC blend and difficulty in getting CPC blend crude into med refiners. So that no doubt has also tightened med diesel supplies and med diesel availability as well. So it doesn't surprise me too much that Sikka to Turkey is one of the few open ARBs at the moment.
And what about jet?
Yeah, so jet's a very different story compared to diesel when we look at this main West Coast India to Rotterdam route. So Sikka is really the best value origin for long haul jet from east to west. We see a very, very strong ARB for October. And even whether it's going through Cape or Suez, it doesn't make that much of a difference. So a very, very different picture when it comes to jet ARBs coming into Europe versus diesel ARBs coming into Europe. But one thing I do want to say with these West Coast India flows is, in general, we have seen these Sikka cargoes move through Bab el-Mandab in July and in August, even despite the Red Sea tension. So I think one concern that I had for sure was whether these cargoes would still be moving through given Houthi risk. but we do still see cargoes moving along that route. Putting it all together in one summary, basically Europe and the US is where distillate premium sits right now. Asia is a little bit looser, Chinese exports helping that somewhat, but overall, yeah, a tight picture. And that remains the case on Disti. Shall we move on to light distillates now? June, one thing I keep hearing about is low water levels on the Rhine. And I'm also hearing EBOB is very, very strong. So what's going on there? Could you explain?
So, first of all, I need to thank Nicholas Plonsky for the views. It is all in the market commentary this week. The EBOB markets basically found support from the escalation of tensions in the Middle East. But yes, the low water levels on the Rhine basically also tightened the European barge market, leaving increasingly few competitive outlets for European cargoes abroad. The bullishness in barges has allowed regional E5 margins to open across prompt windows for ARA blends. This normally suggests a cap on gas net. Components are trapped behind the choke point, meaning that despite open margins, marginal supply will not arrive at the same pace until the barges can go through again. This implies a higher ceiling for EBOB in the short term.
Thanks, June. And how does it look like for RBOB?
RBOB has gained across the week. Flat price, spreads, cracks, as the refined product complex keeps grappling with a tightening global picture, and the US-Iran resolution looks further away by the week. Latest EIA stats saw US gasoline stocks drawing 1 million barrels week on week, but it's more a Pet 3 story than a Pet 1 facing the very low inventory levels. Watch out for the positioning. Net managed money in the COT data has turned more neutral even as pricing rebounded. And RBOB is not really the story here. It's all about EBOB. Yep. The EBOB strength has crunched the prompt paper TA arb swap. Summer grade imports into New York Harbor are unworkable as well. Resupply is not until the 16th of September at the earliest for winter F4 grade. The AG holds open arbs into New York Harbor 2 for the same window. So the delivery region stays scarcely supplied from imports. That means further Pet 1 draws over the next 4 weeks until Houston non-Jones Act cargoes arrive.
Thanks, June. So with this strength in Europe and the consequential sell-off in TA, what do the arbs in the Atlantic Basin look like?
US Gulf Coast exporters now hold wide margin into Mexico, Canada, Central America, Santos, Peru, and New York Harbor further down the curve. US Gulf Coast exports will increase over the coming weeks. US Gulf Coast diffs have been weak on a swaps and cycle basis, held down by cheap freight out of Northwest Europe into Latin America. With exports rising, those diffs gain. One driver to watch on CBOB versus RBOB. Light sour naphtha availability in Houston. Brazilian buyers are taking lower octane components as their gasoline specs move to a higher ethanol percentage. Rising blend costs support the broader RBOB outlook. On freight, 34 vessels are expected in the US Gulf Coast over the next 7 days against a 90-day average of 17 MRs. 17 vessels above average seems like a huge overhang. So on a marginal basis, gasoline offers better export margin than distillate. That overhang will largely favor gasoline flows.
And what about the Singapore market?
Prompt gas east-west have sold off to historic lows due to the strength in EBOB. Singapore cargoes are now landing the cheapest across Pacific Coast Americas, South Central Asia, Eastern Asia, Oceania, and South and Eastern Africa. The market was expecting more Chinese gas exports into the market due to the increased August refined product exports quota, but I argued last week that the actual barrels exported is likely to be lower than the quota due to the crude buying considerations. So the East Mogas market, particularly for September, is looking very supportive. And therefore, we are bullish gas east-west to approach a more normalized value for the September swap.
Interesting.
All right. Anything else we need to cover, Jay?
I think there's a lot to cover. We'll save it for the next podcast as well, but I think we've given a good summary for this week. Yeah, thanks a lot, June.
All right. Then that comes to an end to our podcast this week. For those who are in Singapore for the biggest energy event in the industry, do join us for evening drinks on Monday, 7 September, and for a closed-door breakfast briefing on Tuesday, 8 September. Reach out to any Sparta representatives to get the invites. Meanwhile, my parting words for today. The market doesn't wait for certainty, neither should you. Trade with conviction. See you all next week. Thanks, everyone.